This video is sponsored by XTB, who are launching investment plans, which you'll find out more about later on in the video. What is going on, people? Welcome back to another video. Potential new series here. Every week I'm gonna probably, if there's demand for it, let me know, do a weekly news update. So on Mondays I send out a newsletter that covers lots of different news going on across investment banking, trading, asset management, private equity, hedge funds, venture capital. And so what I want to do, if there's demand for this type of thing, every week do a video where I pick 2 or 3 articles from that newsletter and then share them with you in video form in my own words. If that's of interest to you, it will help you with your commercial awareness, hopefully give you something to talk about when you're in the office or go to work or internships, etc. If you like the idea of that, let me know. With that, let's get straight into the first story. All right, so the first story is about Barclays Investment Bank. A lot of the investors, shareholders of Barclays Investment Bank or Barclays shares want the bank to simplify itself and move away from focusing too much on the investment bank. Why is that? Let's dig a little deeper. All right, so what's going on is the Barclays CEO is feeling a lot of pressure because investors want the bank to be simplified in order to make them, the investors, more money. As a result, over the last year, Barclays stock price has dropped around 24%, which is a lot worse than other banks in the EU and the UK. Specifically, investors in Barclays want the company to sell off parts of its investment bank and get rid of parts of the bank that aren't making much money so that they can focus on revenue generating areas or businesses. One of the issues with the investment bank is that Barclays spends a lot of money on its investment bank, but it actually doesn't make a lot of money back. When you invest in something, you want to see a good return. The investment bank hasn't been performing as it should be since the 2008 financial crisis. As such, Barclays is thinking about changing its goals, and so one of the big moves it's done recently is it's acquired the banking arm of UK retailer Tesco for around £700 million. It's doing this in order to strengthen its retail offering. So JP Morgan, for example, has Chase, its huge retail offering, so it's diversifying. Goldman Sachs has Marcus, although that didn't really do too well. So Barclays is now taking over Tesco's retail banking arm to hopefully grow a business out of the retail consumers rather than just focusing on the investment bank. One of the issues that Barclays faces is that it struggles to find buyers to buy some of its existing businesses. So it's struggling to offload some of its existing business. In essence, a lot of investors are losing faith and they're losing hope in Barclays because 1, they're struggling to sell parts of the business that aren't making money. 2, they're not really being efficient. And 3, they want the company as a whole to focus on more reliable ways of making money so that investors can realize those gains and the share price of Barclays goes up rather than down. Whether you want to break into asset management, sales and trading, or investment banking, investing your money is always a good conversation starter when it comes to interviews or networking. As such, XTB, today's video sponsor, allow you to invest your savings in a smarter way. They've recently launched investment plans on their platform. Investment plans are innovative investment products that allow you to transform your cash savings into long-term investments with low risk. With an investment plan, you'll have the flexibility to create a personalized portfolio of exchange traded funds that align with your risk tolerance, industry preferences, or regional coverage, all for 0% commission and 0 management fees. The plan will then automatically allocate your invested capital to each ETF according to your designated percentage allocation. Some of the main features of investment plans include the following. Simplicity. So the intuitive interface of investment plans lets you easily build and manage your desired portfolio. Diversity. Over 350 ETFs to choose from give you the relevant diversity that you need across sectors and industries. Accessibility. Thanks to the low entry thresholds, you can start creating your own plans from a few pounds so that they meet your individual needs. If you want to start investing in a smarter way, be sure to hit the first link in the video description below and sign up to XTB today. With that, let's get back to the video. Major investment banks across the UK in particular have cut job vacancies by about 50% on the back of a slowdown in deal making, which affects recruitment and it affects bonuses. Citigroup saw the largest decline in hiring. It saw a 75% decline in job openings compared to the previous year. And Barclays, JP Morgan, Morgan Stanley and HSBC also reduced job vacancies by around a half. So if you remember when the COVID pandemic happened, after it actually, a lot of banks were on a hiring spree. They're hiring lots of people and recruiting was kind of flying, right? But all of this is kind of reversing the effects of that. So it's doing the opposite. They're firing a lot of people. So this just goes to show the cyclical nature of working in investment banking. There'll be times where lots of hiring is happening. There'll be times where lots of firing is happening. And so you're never really safe in this type of role. So it's something worth keeping in mind. As well as all of these job cuts, Citi is going through a major restructuring. They're getting rid of 20,000 jobs, and Barclays in 2023 got rid of 5,000 jobs. The upcoming annual results for UK banks is going to show how a slowdown in deal making has had an impact on bonuses. And last but not least, reduced deal making has also led to, interestingly, a decline or job cuts of around 2,000 employees at the big four accounting firms, PwC, Ernst & Young, KPMG, and Deloitte. All right, last story for today is from Willis Towers Watson, an investment consultant. Investment consultants are basically consultants who review and analyze investment products. So the funds or the portfolios that asset managers are offering to clients, investment consultants dig deep on these and they rate them to help clients decide if they should invest with them or not. And so this story focuses on Willis Towers Watson advising everyone to expect a broad range of investment outcomes in 2024. All right, so in 2024, this year, interest rates all over the world are expected to come down a bit. They've been going up over the last few years. And so this year, the expectation is that they're going to drop. And so investors are kind of thinking, all right, what should we do about this? Where can we expect the best returns? How should we shift our investments? Specifically, Willis Towers Watson thinks in 2024, you're going to see different shifts and return expectations and outcomes differing across different regions specifically. In the US, there's a couple of scenarios. Either inflation won't drop as quickly as expected despite rate cuts, or the Federal Reserve, the central bank in the US, might keep a tighter grip on policy, so they're going to be a bit more cautious. As such, there might be a possible small recession on the back of that. This, as a result, could mean you might see a few more ups and downs in the potential returns of US focused investments or US stocks. In Europe, slower economic growth and more market volatility are on the horizon. And also there's a chance that the central bank, the European Central Bank, might lower interest rates. In China, they're expecting a 4.8% growth in GDP in 2024. However, there's still some uncertainty around how the economy is going to recover on the back of the effects of the pandemic. So they go on to say to navigate these changes, it's recommended to have a mix of investments, obviously. A mix of government bonds, so playing it safe, stocks with high potential growth, so a bit risky, and then diversifying into other types of investments that aren't necessarily linked together. So you're hedging yourself. When things are linked together, if they all are affected negatively by the market, then they're all gonna go to shit. If they aren't linked together, they're uncorrelated, then when one does bad, the other might not necessarily do as bad. And so you're hedging yourself. You're spreading your eggs across different baskets, you're diversifying, and that's what they're saying. They also say that the connection between stocks and bonds is expected to weaken, once again highlighting the importance of spreading your investments or your asset allocation across different asset classes. They also say, given the uncertain outlook, it's always good to have some safeguards in place. So you want to have some insurance, you want to play some safe investments too. And this goes back to investing in government bonds, not risky investments, safe investments, low return, but you know 99% what you're going to be getting at the end of the year. The reason for doing this is to kind of hedge yourself against or protect yourself against potential losses in other areas of your investment portfolio. Last but not least, they do go on to say it's worth considering alternative asset classes like private debt, real estate, and hedge funds to try and capitalize on any opportunities that may present themselves throughout 2024. All right, those are 3 news stories. Hopefully you found one of them at least insightful and interesting. Let me know if you want me to do more news story update videos kind of like this, and I'll see you in the next video. Peace.